There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, market watchers, to the Market Watch Tuesday overview. My name is Steve Federal, and the mic here for Auvoria Prime. Try to act in a capacity as risk manager for you. Today's the 9th of August. They're coming upon the Ides of summer. And honestly, a lot of people's moods are not in trading or the markets. At least that's our that's the prevailing profile of our advisor partners and clients. So maybe the trading community will be different. So just in case you guys didn't know, Market Watch is up on Vimeo and our YouTube channel as well. I've plugged this link many times into Telegram. Let's take a look real quickly at the weekly. Oftentimes I will show this. This is FinViz, finviz.com. It's a fantastic dashboard. I know many of you listen to this weekly cast are like, Steve, stop talking about that already. But I mean, realistically, the dashboard I think is awesome. So personally, I like to go to the future space, click on all, look at the daily charts, and just do a quick overview of everything compared to each other. This is going to be a fairly quick cast today. I will tell you that, God, I'd say the last 3 Saturdays, I've probably put up a full hour of everything from my process to overview in markets, macro, all that fun stuff. Our summer book collection continues to move forward. The current book, Narrative Economics by James Schiller. One of my favorite is the book that we are recommending. I posted a picture of that on Telegram. So, let me just take a quick look here. So unless you've been in a coma or living under a rock and you've come back into society, I would say welcome. It's good to have you back. And essentially the markets have lifted a bunch off of the mid-June lows in hopes that the Federal Reserve and maybe other banks from the central developed markets will continue to follow in the path of pivoting to no more interest rate increases, which it's a complete and utter, I don't know, crapshoot, I guess, on that front. So there are crazy times that have befallen upon us, but at the end of the day, the most important thing in almost anything you can do is risk management. So always take a look at what's going on. Don't just glaze over it. Do a deeper dive. Do your own research. Don't pay as much attention to the financial channels. I mean, hopefully I can say this, which sounds maybe I don't know, a bit wild, but maybe you get good enough out there where you can do this particular video cast, podcast I do each week, whatever you want to call it, better than I. If in fact that is the case, and you don't need to rely on listening to this, because I know I have a lot of followers that watch this, hey, then you know what? I've absolutely done my job. That's the best thing I could hope for. Is that everybody will go out and plant their own seed into macro world and not really have any need for old Stevie. So, we shall proceed. So, let's just keep a note here. And again, we're just looking at daily charts, right? Each of these candles represents a single day of trading. But, things in terms of energy land are going down, right? So it's the right trajectory, at least as far as inflation's concerned. Although, interesting enough, look at the price of RBOB. This is what's called gas crack spread futures markets. But regardless of any of the detail you may not want to get into, which I completely agree with, just look at the fact that prices in energy are trending down. Okay? Gold trending up of late. Most other precious metals have followed. Copper's come back. What's that? Probably 10% off the bottom. Is that right? Copper. Palladium's up near highs. Cattle's coming back. But I mean, a lot of costs of core commodities are still down a bunch. Oats. Look at wheat, canola, cotton, lumber, right near a 52-week low. Oh, house prices are all crazy and they're all going to the moon. And if you look at my Twitter feed, I've been retweeting a couple of newer guys I've followed that no, they are not related to any real estate boards. I tell you, always stay away from those types of analysts. Look at the independent guys that have nothing to push, nothing in their book, right? There's some markets where there's been just an absolute flood of supply come on, especially in some hot markets like Austin, Texas, that this particular individual, I forget what his name is, I don't feel like logging into Twitter right now, but you guys can always jump into my Twitter account and see kind of some of the stuff I've retweeted in relation to asset prices. I spend a lot of time, maybe kind of looking in the rearview mirror as far as other asset classes, but I always try to keep my thumb on the pulse of not necessarily what's going on in the art market, but certainly in classic cars. I do pay attention quite heavily to real estate, not as detailed as by geography, but just in general trends are going on, certainly in the states I've used to live in, like SoCal and Florida here, but paying attention to the other hot markets in real estate. We have a lot of clients who are actually selling businesses which are, at least in Florida, commanding a pretty penny, I'll tell you. Good to see you, really. Even though the FBI decides to raid Donald Trump's ex-house in Mar-a-Lago, which is a total political stunt, believe it or not, it is still a great place to be in Florida without all these ridiculous taxes. So, my podium and my comment of the day. Anyways, outside of commodities, the credit markets, again, since the middle of June, really essentially was the turning points for much of these charts that I show, be it the 30, 10-year all the way down to the 2-year note, and the dollar, obviously pulling back. But the cool thing I always like about this is if we're looking at these on just daily charts, you can certainly dial back to look at weekly if you want to see longer term trends or essentially, flatten out or iron out the noise in some of these charts. Always look at a higher time frame, right? Doesn't necessarily tell the story of what's going on right now, but I always think a lot of broad asset prices can be looked at from the perspective of, looking at a longer term, seeing the trends that are going on, not just in the credit markets I talk a fair amount about, right? Because it affects real estate mortgages and obviously lending and every other area of the economy and subsectors, but it also affects the currency markets, right? So, I think that probably the surprise of many of, I don't know, not necessarily our clients or advisor partners, but certainly the trading community and certainly a lot of the Auvoria subs, maybe some of my past students in the trading arena, say, well, Steve, you spend a lot of time on other areas and then you finally get to Forex. Yep, that's exactly right. Because that's exactly how I want you to at least understand how the research should sort of filter down, if you will. I use a lot of analogies out there about, bowling. Everybody would think as many analogies as I use. I'm a huge bowling fan. Although I did have one game I played half in the bag. I think I got like 9 strikes in a row. It's just a fluke, quite frankly. But outside of that, I do enjoy the game of bowling. It's pretty cool. But what I love about bowling is the analogy of one event happening and the repercussions or energy or what have you reverberating into other areas. I call it pin action. It's a concept that I believe heavily in, is that many just pay attention to sort of the bowling ball hitting that first pin and not to the reaction of the other pins. Whereas if you look at most professional bowlers, especially some of the best ever, they spend the vast majority of their time worrying about those far to right pins, right? What do they got to do to get them down, right? What's that called? The devil is what, the 7-10 split? Am I right on that? You know, those two far pins way back there, you know? I spend most of my time sort of being back there, paying attention to what's going to happen if Fed raises interest rate. Yes, obviously maybe the equity markets go down, the credit markets go down, right? But when will they break from each other and begin to be uncorrelated? Whereas certainly this year, they've been correlated. I mean, just look at the 10-year right here. Now you see that chart right there, and that's sort of lifted. Look at how it correlates to just the S&P 500 as an example, looking at equities, right? Was going up, Fed's concerned about inflation, a completely different monetary stance sets in, markets go down, now they're rallying again since the middle of June. So they've been, you know, not perfectly correlated, but very strange period of time where typically when stocks go up, bonds go down, right? Money leaves a asset class that is more aggressive, what they call risk on, versus, you know, piling into an area of the credit or bond markets, which is considered to be like a risk off, right? And then that has events that play out into the dollar, which is why I always sort of work my way down, just like you see the research set up on FinViz. It's almost like they want you to think in terms of broadly what's going all the way through all the other markets, and then Forex is at the bottom, right? So maybe that's just by luck that the layout follows my research, but I kind of like that. So, but there really hasn't been much to glean since the big old reversal after just an absolute massive run up in the dollar over the last, hell, I'm going to move the weekly chart on this one. It's easier to see the broad moves, right? But if you look over the course of, you know, periods of time in certainly early 21 during the pandemic, monies, albeit as its own evil, certainly this country with its own levels of debt and trillions, it is certainly seen as the lesser of all evils right now, right? So money's been piling into that, especially since May of 20, right? And if you take a look back at a monthly chart, I mean, it goes back to 99, which is pretty much where the trading view data starts, a little further back than that. This isn't the highest it's been ever, but, you know, it's pretty close. So, you know, at least as far as my research goes, or looking back in the markets without anything getting back into, you know, further into the early 80s and stuff, which we don't really have data on in FinViz. You can get that stuff all the way back if you have a more sophisticated system like Bloomberg, or you're pulling from some other CQG-based database. But, you know, the highest the U.S. dollar's ever been as far as the DXY index, essentially is 119, almost 120, right? So if you switch over to Euro-US dollar, let me just back right up here. Keep thinking I'm going back to the main dashboard. So here's the euro. You've seen the opposite of that. You know, this is a daily chart here. You know, it's essentially begun, you know, a complete descent, right? It's basically parity now. So with parity, which we're not quite at yet at this point, but we were at one point in July. So essentially, I get like a bazillion emails here. Apologize. Kind of going crazy with all. We're actually meeting with some. We're actually meeting tomorrow with some pretty big NSA people at Fort Meade, right outside of DC, which is really cool. So our sort of first downs foray into the government / TSP markets has been paying off quite nicely. So maybe from a risk standpoint, I'll have more insights once I get, and our firm hopefully gets a little sort of deeper in bed with some of the different agencies of the government, which we're going to be going into meeting with, since we've been very, very, very fortunate that we've been riding sort of the red carpet into these agencies with a couple of our big publisher relationships with the government publications. Just totally cool. But hopefully they're seeing the value of us as well. But in any case, the euro, as I digress, although I'm getting a lot of emails from Fort Meade today. Any case, so then is the euro, no surprise, been talking about this. Yen, I know not a lot of people trade it, but I just want to show you guys the same chart I showed, it was a couple Saturdays ago. Yeah, back to the worst levels ever since 1999. You know, when you have stuff this bananas, right? And certainly it could go lower, right? Set new lows, and you know, the country could just be, you know, completely circling the drain. But I gotta tell you, from the standpoint, I'm actually almost thinking of opening up equities, or I should say ETFs that cover the yen in client portfolios. You know, just there's a whole bunch of ETFs out there that can give you exposure to varying degrees of Asia. But the only exposure I'm interested in just comes in the form of Japanese, just because this currency's just been so absolutely hammered over the course of the last 20 years, and certainly recently since the peak of 2012. This was the whole financial crisis here, which sort of morphed itself depending on what part and what asset class over the course of a couple of years, certainly in real estate. I almost think this is a buy right now. So stay tuned. I haven't put a lot of effort into the research on this, but if we do open up a position inside client accounts for yen-based stuff, would be more long-term. So it'd kind of be boring stuff that most traders wouldn't care about anyway, but it certainly would be a first for us. So, and this is kind of one of those things where and a lot of my friends joke, you know, I'm always looking to sift through the ashes of any fire sale, right? Asset classes in the absolute toilet. Maybe at the core, I've sort of morphed into a value investor over the last couple of decades versus, you know, chasing all hot tech-based stuff I used to do in the late 80s. But hard to argue with Dell Computer going up 5 points a day for like 3 months straight. Paid for part of my townhouse, so I can't complain. In any case, you guys don't want to hear about my stories. They're all boring, right? Let's talk about the markets. So let's get out of here. Just for purposes of tomorrow, all the eyes are going to be on these CPI reports. No surprise, you can click on these reports. They've been ugly. Question is, how much more ugly will it be, or will there be a surprise? I think that this is certainly something that you don't want to really trade around, in my opinion, as a trader. And certainly from the standpoint of somebody that now lives on the East Coast, most of the financial world, at least in this country, is all based on Eastern New York time. So it makes it much easier from a trading perspective, instead of having to look at these reports at 5:30 in the morning when I used to live in San Diego. It's much easier messing with this stuff when you get in the office, which I typically do around 7 a.m. So, in any case, so keep in mind that that's important. Let's jump into the charts. I'm going to go on too much of this. I did want to take a quick look at gold spot market. Pretty nice little rally off of a very, very solid 1690. I talked a ton about this way back in the end of 21. This would certainly be an area that you could initiate a position, and then I'm not going to say I missed the boat on this, because I think we'll probably go back down and touch it again. But I'll tell you, this is certainly could have been an area to enter gold into your allocation if you so desire that type of diversification. But you know, as I always tell everybody, limit it to, you know, unless you have absolutely millions and millions of dollars. I typically will limit these allocations in gold to maybe a max of 5% of the portfolio for a client, unless all hell is breaking loose, right? In which case I would argue for higher gold allocations. I just don't see that in the cards right now. Mostly because a couple people have asked me, this just is not a good chart from the standpoint of bullishness, right? But this was an area where other time frame players came in to support, right? But it just, every time this thing has just rallied a bunch, there is just players out there, big institutional, just looking to dump. They really are. I don't know if it's governments or, it's hard to know who the hell's selling this stuff. Everybody has sort of their big, dark, poolish way of dumping large positions, right? They can filter them through a bazillion different entities, and it'd be hard to track the sale of this stuff. But it doesn't matter. I mean, the charts don't lie. I mean, the price action's been bearish. So for the Auvoria subscriber that dinged me on that, oil. We don't really trade this, but just for the purposes of your overpriced and gas guzzling V8s. Now we're sitting on the edge of the cliff right here. So we break this area, I would imagine we will sail down to probably about 77. There's no support under this. See these notches missing right here, right where this dotted line is? See that missing notch? I think that'd be our first stop. So it's almost like if we can close under one of these candles, and look like this one's gonna, but if we can close under this squeeze zone area of 88, looks like 88 and a quarter area in oil, and imagine this is just gonna scream down probably a fast $10 if you are trading it short, but it has not shown itself to do that yet, so be careful. Bitcoin still mired in the sideways trading, nothing breaking higher. I have not looked at GBP CAD in a while. Let's take a look at that on a, let's actually go to, let's get a weekly chart on this. So as I've shown before in the past, we had a very, very pronounced, exceptionally well balanced trading zone, right? Just essentially this is a sideways action, but really, really acted quite well, and then we broke out of it, and now we're testing into other areas. Obviously no surprise. Weakness in the pound related to a lot of events, primarily Ukraine, I would say, was the start, right? And then inflation and the pandemic have sort of set in motion a lot of these countries spiraling. I got to tell you, some of the stories coming out of Europe, if true, this energy craziness, I really feel for everybody in Europe. It just seems quite bananas depending on the country. If these stories are true, right, I guess that's a big if, but some of these energy prices these people are paying are just nuts. Y'all need to start coming down hard on their regulators. Let's see what else. Take a look at just the pound. So the relationship between the British pound and the US dollar, back to daily. I wanted to note this for everybody too. We're in a squeeze zone now, so we're sort of tightened up the trading range. So this potentially could break itself out higher. Seems to me from if this continues to have positive side trading action after the complete drubbing that this currency has taken, I think we possibly may have another step higher, depending on how this chart plays out. See these two dojis forming here? Forming, I should say. Formed yesterday and potentially forming today. These are indecision candles just like these, so typically if enough of them print, it tells you that at least at that point, no other large folk are looking to step in and take the market higher. That usually means the prevailing trend will continue at some point. So it's almost like a pause. Let's see what else. GBP. So here's Euro. This is a daily chart.
Yeah.
Let's also take a look at don't think I've shown this in a couple Saturdays, have I? Not much going on here as far as the Australian Canadian currency. GBP NZD, still that big sideways trade. Nothing crazy going on there. There's a relationship between two continents right here. Both of them make absolutely fantastic wine, by the way. Euro GBP. Tell you this center point of volume right here, which is perfectly line itemed, if you will, what's called a point of control. The bottom of this is where the most volume is executed right here from a market profile perspective. That's why there's a point of control line of what's called a POC. It's just nothing more than a tip, if you will, of the arrow of a large amount of trading. So it shows you why what price is holding here. Other reasons as far as supply, as far as moving averages, but from a supply-demand perspective, oftentimes price will be held or hovered around or bounce off of lines of where the largest amount of volume takes place. So why I'm constantly talking about market profile has a lot to do with with that. I always want to know where the volume is. But if you look also underneath here, and a lot of it just has to do with notice if I scroll and tighten, I really tighten these candles up, see how the data jumps around. The reason that happens is because I'm essentially tightening up my window of view, so August to August. So essentially we're looking at a little more than a year in this window, and it pulls the data in terms of all volume that's executed, at least from Onanda's perspective. But notice down here, see how we have it's almost like an incomplete auction down here. See that right here and down here is an incomplete auction that we're far away, but a lot of times this stuff can just be absolutely magnetized to this area. So I think it's important to understand that yes, price may not, sort of venture down into this area right now, but at some point I'm pretty sure it's going to want to trade in this area. Why? Because there's an incomplete auction from a volume perspective. It's also a whole bunch of just nothingness, right? Not only in price action, obviously, but to just know that it may not be soon, but this type of view, if you will, or insight, oftentimes it can be an area of attraction. So you'd want to see something from, if you're an auction market theory expert, you'd want to see it go down there, spend some time trading under here, develop volume, and essentially what that does is puts together a more complete auction. Okay. Alright, so I think I'm going to just leave it at that because I've got a whole pile of emails coming in I got to take care of. Alright, so as always, that is the updates. We will continue to monitor the international markets for you guys here and anything that breaks, but I would highly suggest, if you have time, go back the last couple of Saturdays and view my previous casts. You can see all the stuff I've talked about and hopefully you can take some good nuggets out of it. I wish everybody a great week. Be safe. May the trades be with you.